All right. Hello, everybody, and welcome back. Today we are going to go over chapter 4, which is going to be the accounting cycle. All right. So, what chapter 4 is basically what we're going to be learning is going to be the fundamental rules and guidelines that accountants must follow in order to continue one, doing business, but recording transactions the way they are and posting their financial statements. So these are the fundamental rules and guidelines, okay? So we're going to go over that. All right. First thing is accounting cycle. Well, what is the accounting cycle? The accounting cycle is a methodical set of rules and regulations or procedures to ensure the accuracy of accounting. Okay, so again, making sure that the procedures and the process of recording is accurate and most reliable. Okay, again, we have 4 characteristics of these specific things that we need to look into. We need to make sure that our financial information is 1, reliable, meaning that it's true evidence and true proof that we recorded every cent. Second is it's relevant, meaning that if we're doing business in 2015, all our transactions have to be within 2015 to keep it staying relevant. If you opened your business 2015 and you decided to go back in time and write up reports in 2012, it's not relevant because, with the money, your numbers are going to be inaccurate. Okay? So it has to be relevant. It has to be within the times and making sure that you follow up every guideline that is up to date. Third thing is it has to be consistent. Consistent meaning if you're going to choose one type of method, make sure that you're consistent and you use the same method going throughout the entire process of recording your transactions. Okay? We learn all the methods because you can choose a certain method you want to use, whichever one is easier for you, whichever one that makes more sense to you. However, you can't be toggling back and forth. You need to choose one and be consistent and stick with that one. Now, there are some rules that you can go ahead and be able to do that, but you would have to wait till either to the end of the year, and you actually have to report it to your agency that gave you the business license or the taxation, the IRS. You have to let them know why you changed, and second of all, when you changed it. Okay? And then lastly, it has to be comparable. Now, comparable meaning the information that you release, so your financial statements, it has to be able to be recognized and compared to another business in the same exact industry. So, for example, my Walmart financial statements must look, if not exactly identical to Target's financial statements. They're in the same industry. They both sell products, clothing, and they sell groceries. And they should reflect the same kind of information. Okay, so that is what it means to be comparable. If Walmart starts putting in a bunch of accounts that are unrecognizable and they compare it to Target, then that's where it poses questions and poses, well, what are all these extra accounts? What are you doing with them? So again, making sure that your financial statements are easy to read and comparable to other companies in your industry, in the same industry. So again, the 4 characteristics of financial statements are the 2 R's and the 2 C's. Reliable and relevant, consistent and comparable. All right. Now, so the accounting cycle is broken down into 10 steps. All right. First step is obviously to collect your source documents, meaning collect all your receipts, collect all your invoices, collect all your bills that you owe people. Second thing is you're going to analyze it and you're going to sort the data. So again, using the transaction analysis. How does this transaction affect your business and where are you going to be placing them? Third thing is you're going to record it into your general journal, right? Again, everything that you see, so you're going to record everything that affects your business. The fourth thing is you're going to post it into your general ledger. Now remember, the general journal is just you doing your daily transactions. The general ledger is going to have your ending balance in every single account at a specific given time. So again, if you're looking at a bank statement, at least that way you can make sure you have enough money at the end of the day instead of just writing a whole bunch of checks and just letting them all go, right? At least when you post it to the ledger, you know that you have enough money. Then the fifth, 6, 7, 8, 9, and 10 is going to be called the closing process. Now, what this whole section is it's going to consist of doing what's called unadjusted trial balance. So this is just us comparing. Did we accurately do our accounting correct? Do all our debits match our credits? All right. And then we do what's called adjustments. So when we look into it, when we go into our actual, throughout the entire lecture, we'll learn what adjustments entries are. So for example, if you've heard of depreciation, when you buy assets, they're not going to stay the same because you're going to use it, right? It's going to depreciate, and that's an adjustment entry that you need to record. You need to record that this year you used the machine, so that means this year it's not worth the amount that I actually purchased it for. Once you do that, once you've had all your adjustment entries, then you're going to create the adjusted trial balance. All right? Now, once you've done that and they all line up and match up completely, that's when we're going to be moving into creating the financial statement. So again, there's 4 of them. So once you've done that, that is when you can look at the information that you've created and kind of see, okay, profit and loss. Did I make a profit? Did I make a loss? Do I need to add the money back into my equity and make my company more increase the value of my company? Did my assets equal my liabilities and my equity? And then lastly, how much money is really flowing into the company and how much money am I really spending, right? Then after you've done all that, you start closing the books. Now, again, we won't learn this until the end, like towards the end of the class. So towards like maybe week 10-ish. That's when we're going to be looking at closing the books. Now, every end of the period, you need to close your books out because we're going to have to start our business again. We're not making the same expenses. We're not doing any of these things. Maybe we're going to, purchase more inventory that we've never sold before. So things like that. And now that's why we need to close our books. Once we close our books, then you have to do one more trial balance just to make sure that when you close out your books that everything lines up and matches. Okay? So those are the 10 steps. Now, again, I'm going to give a brief example of each one. Step 1, right? We're going to collect our source documents. So again, it could be any receipt. It could be any invoice. It could be any document that is proof of a transaction. Step 2, we're going to analyze it, right? Again, we're going to be answering the 3 questions. 4 questions. What happened? When did it happen? And how did it happen? So again, if you look at this example here, we purchased supplies. When did we purchase the supplies? We purchased it on this day. How did we purchase supplies? We bought it with cash. Okay? and then for what amount, and it's right there. So again, answering those questions. Then we journalize it again using the transaction analysis. We understand that, okay, I'm going to separate it into office supplies, and I reduce my cash value. Then I'm going to post it to my ledger. All right, so at the end, I know that at the end of June 6th, I have a total of $19,000 left. So I'm good. I'm good with cash. Okay. Step number 5 is we're going to prepare our unadjusted trial balance. So again, it's going to list all the accounts, and our main determination is did our total debits match our total credits? And in this case, we bought office supplies, we bought furniture, we had sales, and we had rent expense. Okay? And they matched. Then we're going to be looking into our adjustments. So again, furniture is one of those assets that actually depreciates. We also have to recognize periodic expenses. So if we have periodic inventory, we need to convert the expense into inventory. Other things is we have supplies expense, because if we're buying supplies, we're going to use it, right? So how do we determine that? Do we still have this amount left in our supplies? No, we used it. So making those adjustments. Then again, after that, we need to make sure that once we made the adjustments, that everything, our accounting was accurate. And what we did was we made sure that they, all the debits match our credits. Okay. Then moving on to step 8, this is where we got to create our financial statement. So again, we got to create our income statement, and we got to create our statement of owner's equity. Then we got to go check our balance sheet. Does all of our assets equal our liabilities and equity? And then lastly, again, how do we know how much money is coming in, and how do we know how much cash is flowing out? And then when we do closing process, so again, this is when we will learn this and further on, but how we close it is we close out all of our revenues into the income summary. And then after that, we close all of our expenses to income summary. And then at the very end, we have the choice. When we close out at the very end, we're going to close out our income summary to our equity. Now again, if you're looking at a corporate standpoint, you have a little account called retained earnings. Now with retained earnings, that's the money that you can actually take out. If not, it goes back into the company. But because we are dealing with a private sector and we're dealing with sole proprietors, we only have income summary, and it goes straight to equity. Okay? And then lastly, we make sure once we convert everything and put all of our expenses and revenues into our equity and close it out, we need to make sure, did we do it correctly? And at the end, we need to make sure that our debits match our credits, right? So that's the whole 10 steps in 5 minutes. All right, next thing that we're going to be focusing on is going to be the accounting period. So again, what is the accounting period? It is when the accounting cycle is scheduled to be completed. So whenever you think that your company needs to, again, close out the books and start a fresh page, wants to go through all those 10 steps that we just talked about, is going to be your accounting period. So that means you can either close out every day, you could close it every week, every month, every quarter, semi-annually. The only thing that you can do is up to annually. I've never seen anybody go back 5 years and report their books 5 years. Okay, so the maximum you can go is 1 year. Okay, and most major corporations, they tend to do they do their financial statements. They release them either quarterly, but they don't file taxes until annually. So make sure you kind of aware of that. Now, common ones, if you're a big company, you definitely want to do either daily, weekly, or monthly. Reason being is because you have so many transactions to keep up with that it's best to make sure that you close your books, just to make sure that you've counted all your debits and you counted all your credits, and they're equal to each other. Smaller businesses, you can get away with either quarterly, semi-annually, or even annually for someone that doesn't really, or like a small startup company. But generally, a lot of companies would want to do monthly because they also want to do projection analysis. They want to see, well, is my company improving at all in the last 3 months? So that is why they would generally choose a monthly. Monthly is the most common one. Now, there are 2 ways you can choose what kind of period you want to go for, right? So the easiest one is to do calendar year. Calendar year, you start on January 1st, you end it on December 31st. Right? Now, most common companies would more likely go for a fiscal year. A fiscal year, right? It's 12 consecutive months starting on the first of the first month and ends on the 30th or the 31st of the 12th month. But the key word is 12 consecutive. Okay? Now, they would choose fiscal years primarily. It's going to be based on when they want to file their taxes. Okay? So again, a great example of that would be a swimsuit company. Your profits would skyrocket during the summer period, right? Your sales are going to be higher in July, August, September, right, during the summer, because people are more likely to go to the beach, or they want to go swimming, or they want to go to the lake. So they would typically have their periods they would select it based on the season that they want to file their taxes, where it's like towards the winter, where it's less sales are happening because you're a bathing suit company, right? Less sales are happening. You know, you're more likely to be able to prepare your statements better and do your transactions and everything more better for the winter. Okay, so again, this is you guys can as a company, you guys are able to choose either calendar or fiscal year. Okay. Now we're going to be moving on to the generally accepted accounting principles. So again, this is the book that you need to follow. These are the principles, these are the rules that you have to follow in order to do accounting. All right? Now, before we get into those rules, I want to make sure that you understand that who are the people that are behind it? Okay? Who are these people that are in charge of having these accounting principles enforced? Okay? And that is the Federal Accounting Standards Board, or also known as FASB. FASB for short. Okay? Now again, financial statements, okay, and let me see, and other methods, okay, these FASB is the creator of these procedures. They are the ones that have to go through it every year and see if there's something that they need to make changes or rules or guidelines to. Again, you'd be able to find this information on irs.gov, okay? So, again, its purpose is to create generally accepted accounting principles and standards, rules to ensure that there is no potential for fraud, but also making sure that the business transactions are fully being recorded and properly, everything's being properly reported, as well as properly submitted into the government. And of course, GAAP, right, is generally accepted accounting principles. Only the U.S. uses GAAP. Okay? Only the U.S. uses GAAP. Now, we are going to be looking into European and other foreign countries. Not every country uses the international financial standards, but I do need to introduce you to it because they're like our common relative, right? This is the one that we've been trying so hard to work together with to try to make a universal accounting rules, okay? So I want to introduce you to the International Accounting Standards Board, okay? So they're based in London, England, okay, and they're responsible for creating any international standard rules and stuff, which is also known as the IFRS, which is the International Financial Standards. The International Financial. Oh shoot, I forgot what R stands for, but it's standards. Okay, so they have their own set of rules. For us, it's GAAP. For them, it's IFRS. All right, and then again, that applies to Europe and other foreign countries. Okay, so they do have a little slight difference in their rules and how they do accounting. All right, now there are a total of 12 rules under GAAP, and they're divided into 3 categories, and I'm going to go over every single category. So the first category is going to be the assumptions. Now the first rule or first assumption is going to be the business or economic entity. Now again, this is very, very important, especially when establishing any form of business, whether it's a sole proprietor or a partnership. You need to establish a separate I'm sorry, I'm trying to find the words. You want to try to find a separate way to determine from personal and business, okay? It is very hard when you're a sole proprietor, but the key thing is you want to make sure that you keep your business transactions separate from your personal transactions. You cannot use.
That sounds like we would have to create an LLC or right?
No,
For
no,
that
no,
part.
no. No, 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 no. Not anything like that. Again, I guess for an example, for the business or economic entity would be if you are a sole proprietor, you need to make sure that you have a separate bank account that's for your business. That's all it's asking you. To make sure that you draw a fine line to separate between business and personal. You can't be taking assets from your business and use it as your own personal setting. Like I'm going to buy a couch using my business name, but use it as a couch for my personal home. No, you cannot do that. You need to separate your transactions from business and personal, okay? And again, the biggest one that you can do is a bank account, okay? Yes, for sole proprietors, when you do open a bank account, your name's on it, but it's also your company's name is also on it as well, okay? So just being aware that you recognize the difference between your personal transactions and your business transactions. Don't record personal transactions in your business books, because that is one sign of fraud, because you're using your business to do everything for personal use. Okay? Second rule is going to be the going concern. Now, this is So the definition is even if you have a foreseen foreclosure, as in you know that your business is going to go bankrupt or anything, you are going to continue the business as if it is everything's normal. You would still continue doing business as if nothing is going to happen. Okay, so for that example, I know my business is going to close, but I'm going to continue serving my customers until I for surely close my shop that day. So that is what the going concern principle is. Number 3 is going to be monetary. So there are, There are 3 subheadings for this monetary assumption. They're pretty easy to understand. First one is monetary unit, which is establishing one type of form of money or some kind of currency that you're going to be using throughout your business. So again, in the US, it's going to be the US dollar. Okay. I have heard that some businesses are incorporating cryptocurrency as their form of currency, but it's not established through all the United. Not everyone in the U.S. uses cryptocurrency as a form of currency for their business. They primarily use the U.S. dollar. That's all that rule asks. Okay. Number 2 is monetary measurement. So what does that mean? Okay, so when journalizing, you're going to journalize based on the dollar value. So for example, my business has 12 employees. When I journalize that, I can't journalize that I have 12 employees. I have to journalize how much it costs me to have those 12 employees. All right, that is monetary measurement. So again, I cannot journalize 12 employees. I need to journalize the total cost, the value of how much it's going to cost me to have 12 employees. All right, so everything is in terms of dollar value, okay, money. Third thing is stable currency. So again, when you're utilizing the form of currency or establish the dollar, obviously, making sure that all your revenues and all the stuff, that everything is up to its current dollar. So again, utilizing the how every year the dollar value changes and it changes by like 0.7 of a cent. You need to be current with that and making sure that you're that it's a stable form of currency and that it's relevant to and when you measure it, that it's accurate to the dollar value as if it's today. All right. Now that means when you do make predictions, obviously you're gonna have to remember that there's inflation, and we'll talk about that when we learn about time value of money. So making sure that the money that you're using, it's a stable form of currency and that it is up to date to what its dollar value is really worth. So making sure that you do that. So that's rule number 3. The last assumption that we're going to be looking into is called the accounting period. So this rule means that you need to set an accounting period. Okay? And remember, the accounting period means, are you going to do it every month, every day, every week? Are you going to do it every year? You need to establish that. Okay, that's the most important, right? Because that allows you to break the accounting period into into certain sectors, so you can determine performance values. Okay, so that is all the assumptions here. All right. Next is going to be basic principles. Now, basic principles is going to be number 1, historical cost. This is very important when you're purchasing assets or purchasing inventory, or purchasing land, for example, okay? It is very important that when you record it, that you record it at historical value. You never want to record it at market value. Now understand the difference between market value and historical cost is, yes, typically when you buy inventory, you're going to buy it at what the price it is as of right now. But when you're looking into land, you're not going to buy it at market value. You're going to buy it at original price, and let's say you do sell it, you're not going to profit that recognized gain if, let's say, the land actually became more expensive. You cannot recognize that. You have to record it at historical cost, because then you're creating money out of nowhere, right? So it's very important that you record everything at historical cost, and that you do not change that value over time. Okay? The only exception is actually securities and inventory. So again, inventory can actually lose its value over time, and yes, you're going to have to recognize that, but you would recognize that as a loss. Securities, obviously, they increase over time. It's like buying a bank bond, right? It's going to have value because that's what the purpose of a security is. You're trying to create interest income off of that security. So that is the only exceptions there. All right, number 2, realization realization or revenue recognition. So again, this is when recording revenues, right? And you record it when it is realized. For example, when you make a sale, not only are you recognizing your profits, but you're also recognizing that you sold something and that you need to take your cost out. So you're recognizing that you've earned something, you've earned income, and you need to record it. That's what that rule is. Okay? Number 3 is matching principle. Matching principle and revenue recognition go hand in hand, because not only do you recognize that you sold something, you recognize that you gain a profit. You generated revenue, right? So, and it has to match the exact sale. So when we're dealing with how much cash we received, how much of it did it cost you to sell the item, and how much did you actually how much was your profit? So again, matching and revenue recognition go hand in hand, okay? So yes, that sounds very similar. Number 2 is the act of recognizing it. The number 3 is confirming and making sure that you match it against the numbers that you used. Okay? And then lastly, number 4 is adequate disclosure. Adequate disclosure is essential, especially recording any excess information that needs to be revealed. Okay? If you write that I have employees, right, and they cost me a total of $50,000, does that tell you anything? It only tells you that, yes, 1, I have employees, and 2, it cost me $50,000 just to have them. What adequate disclosure is, it allows you to record that 12 employees in a special area called notes to the financial statements. So again, with that, you can list 1, who your employees are. 2, what kind of status they are. 3, are they salary based or wages based? Are they commission based? So that's where you can reveal all that information into the financial statements. Okay, but you cannot record that information when you journalize it. Okay, it has to be dollar value. But there, okay. All right. lastly is your constraints and your conventions. So again, number one is going to be materiality convention. So this one's kind of a concept that's kind of hard to understand. So what this one is, it's basically saying, is this item, can you put a dollar value on it? Is it worth something? Does it have materiality? Can you put a dollar value to it? So another one example would be gold, right? Gold, yes, but we can't say gold is gold. We have to put a dollar value to it. So that's what it means by materiality. How do we measure how much it's worth? And is it significant enough to record? Okay. Number two is cost benefit convention. Now this is when we make a decision, right? Is it beneficial for us? So this is an example. So this is what the definition says. Does it benefit us to release our financial statements for the cost that it costs us to produce it? Does it give us a beneficiary value if we release it, but does it cost us to release it? So it's kind of like weighing the option. Will it benefit us in the long run? And that's what that rule is. And so again, it's actually very, very expensive, especially when you're looking at a corporate standpoint, to have someone do your entire financial statements, do the entire closing process, the accounting cycle, right? It costs a lot of money. And does that benefit anybody? So what that means is, will it benefit you as an internal user, someone who works for the company? Because then, yeah, you could be like, yes, my company's making money. That means I'm going to be making money. And it could be a benefit to your investors too. Maybe someone says, ooh, these financial statements are good. I'm going to invest in that company. So the decision is what you're going to do going to benefit you for the cost? So again, I used a t-shirt company. Is it going to benefit you as a business to ship your stuff out of the country to get it done because it's going to cost you cheaper, but there's delay time? Or would it be beneficial for you to just do it here in the US, which will cost you more money, but the benefit of it is it's going to be done in a day? So looking at those options, what is going to be beneficial for you? Okay? And that ties in with number 3 is which decision or which alternative is going to least likely overstate your assets. So again, this goes in like, if it costs me more, then I need to raise my prices more. If I go with the other one, I could probably make more money if I can get it for a lower cost. So 3 is confirming which alternative is going to least likely overstate your assets. And then lastly, number 4 is industry practices. This is going to look into, well, if for example, Target and Walmart, right? If Target is doing something to their financial statements that you think is actually beneficial for your company, Walmart should actually kind of follow it just because they're in the same industry and because they're doing some kind of guideline rules and it benefits them. You're more likely to want to copy and do exactly what Target is doing. So again, for example, if the FASB created a brand new accounting rule, but you're so set in stone to just continue using what works for you, but you realize that someone in the same industry is utilizing the new rule, you're more likely to follow along because of 1, trends, and 2, maybe the new rule makes it easier for you to do. So that's what that rule is. Okay? Any questions about anything I talked about GAAP? All right. So this is the last concept. It's going to be cash basis versus accrual basis. So this is very easy. It's very easy to understand. Cash basis is basically you're running your business purely on cash. When you receive money, it's cash. When
I'm
you're
sorry,
spending money, it's
starting to
cash.
echo, so I can't really get what you're saying.
Let me check who's. Hello? Okay, much better.
I can hear you. Yeah.
Okay. All right. All right, so going back to this. When we're dealing with cash basis, everything is in cash. You receive cash, you made sales, everything's in cash. When you pay off your bills, everything is in cash. Okay? So the key word is you recognize revenues when cash is received. Okay? You recognize expenses or any payments that you've done is when cash is available in your hand and you spend it. We are going to be focusing on the accrual basis, which says that transactions, such as anything that has to do with income, they are recognized when it is earned. Okay? So, meaning, let's say I sold a product. I'm going to recognize it because I earned the income right then and there, even if they owed me the money. I made a sale, I earned the money. Does it mean that I have to have cash in my hand? No. They owe me the money. I still made the sale. They still owe me the money. And that's the concept of accrual. Again, expenses and debt are recognized when it has been incurred. So the minute you receive a bill is incurred. I owe that person money, right? And it's an expense that I know I have to pay. All right? So this is where accounts receivable and accounts payable come into play when you're dealing with accrual. But when you're dealing with cash basis, it's just purely cash. All right? So again, course for review, we went over the 10 steps of the accounting cycle. We went over the accounting period, right? It could be as long as it's 12 consecutive months, all right? You could either choose daily, yearly, weekly, monthly, whatever you want to do. We recognize the difference between calendar and fiscal year. We understand that the 4 characteristics must be relevant, reliable, consistent, and comparable. This is what I like to tell people when you're looking at understanding the generally accepted accounting principles, GAAP. I think of it as you learning your ABCs, your assumptions, your basic principles, and your concerns. I mean, conventions and constraints. Okay? A, B, and C. Right? Again, just recognizing that each category has 4 of them. I haven't figured out a mnemonic device to memorize under each category what they are. But in total, there are 12. They're split into 3 categories, and there's 4 in each category. Okay? So again, learning GAAP is learning your ABCs. And then lastly, understanding the difference between cash basis and accrual basis. When we are learning, when we do our business and we do our class project, we'll be learning primarily accrual basis because that is primarily what a lot of businesses do as of today. If you can allow an account, that right there is an accrual basis. All right? And that is it for chapter 4. Any questions about chapter 4?
No, I don't have any questions. I just want to know